Imagine being able to buy a home without a deposit, even if the bank says you don't qualify for a normal home loan. Sounds impossible, right? Well, thousands of South Africans are doing exactly that using something called a pension-backed home loan. But here's the catch. While it can help you buy property much faster, it can also put your retirement savings at risk if you don't understand how it works. So in this video, I'll explain what a pension-backed home loan is, how it actually works, the advantages and disadvantages, which banks offer them in South Africa, and when it actually makes sense to use one. Let's get into it. What is a pension-backed home loan? A pension-backed home loan is a housing loan secured by your pension fund savings. Instead of the bank relying only on your salary and credit score, the loan is guaranteed by your retirement fund. In simple terms, your pension fund acts as security for the loan. This means if you fail to repay the loan, the bank can recover the money from your pension savings. This type of loan is commonly used for buying a house, building a house, renovating or improving a home, paying off an existing home loan. But there's an important point many people miss. You do not withdraw your pension money. Instead, your pension fund guarantees the loan to the bank. How pension-backed loans work. Let's break down how the process usually works. Step 1. You apply for a pension-backed housing loan through your pension fund or employer benefit scheme. Step 2. Your pension fund checks how much of your retirement savings can be used as loan security. Step 3. The pension fund then guarantees the loan with the bank. Step 4. The bank gives you the loan for the property or renovation. Step 5. You repay the loan monthly, just like a normal home loan. But here's the key difference. If you default on payments, the lender can claim the money from your pension savings. This is why it's called a pension-backed loan. Banks and institutions offering pension-backed loans. In South Africa, pension-backed housing loans are usually offered through retirement funds partnering with banks. Some institutions involved include Standard Bank, First National Bank, Nedbank, ABSA, and some pension fund administrators such as Old Mutual, Alexander Forbes. However, access depends on whether your employer's pension or provident fund allows housing loans, so not every employee automatically qualifies. Now let's talk about the benefits. First, you can use the loan with a regular home loan as a deposit on a property. This is a huge advantage for many first-time buyers. Second, easier approval. Because your pension fund secures the loan, banks may approve borrowers who might struggle to qualify for a traditional mortgage. Third, lower risk for lenders, which sometimes means better access to financing. Fourth, it can help you build wealth through property ownership earlier instead of waiting years to save a deposit. Here is the list of other advantages. The maximum loan term is up to 30 years. However, this is dependent on individual fund rules. You receive favorable interest rates and fees on your loan, which is negotiated with the fund. You can use a pension-backed loan to buy vacant land, build a house, or improve your current home. If the prime rate changes, your loan term will adjust rather than your repayment amount, unless you are too close to normal retirement age. Monthly loan repayments are conveniently deducted from your salary or wages. But pension-backed loans also come with serious risks. Now let's talk about the disadvantages of pension-backed loans. The biggest one is risk to your retirement savings. If you fail to repay the loan or exit the fund, your retirement savings will be used to settle the loan, which may have tax implications. That could significantly reduce the money you retire with. Another disadvantage is limited flexibility. Not all pension funds allow this type of loan, and the loan amount is often limited to a percentage of your retirement savings. The loan can only be used to buy, improve, or repair residential property, or to pay off an existing home loan. The loan needs to be repaid by the normal retirement age, as set out by the fund. Sometimes you must own the property to qualify for a pension-backed loan. Finally, some borrowers forget that this is still a debt obligation. You must repay it monthly, like any other loan. When is the right time to use a pension-backed loan? A pension-backed home loan might make sense if you are a property investor, you have stable employment, you plan to stay in the property long-term, you don't have enough savings for a deposit, and the property is likely to increase in value over time. But it may not be a good idea if your job situation is unstable, you already have high debt, you can't manage debt, or you're close to retirement. So yes, pension-backed home loans can be a powerful tool to get into the property market, but they should be used carefully because you're essentially putting your retirement savings on the line. If you found this video helpful, make sure to like, subscribe, and share it with someone thinking about buying a home. And let me know in the comments, would you ever use your pension to buy a house?